Joining us now, Yardeni Research President Ed Yardeni. Ed, look, it's good to see you and have you articulate the, sort of reiteration of what you were seeing back in the 90s. Although I wonder about something. There's no doubt about it. The supply concerns have been very heavy on this market. As soon as the Treasury announced its issuance schedule back in July, it seemed like we released higher in terms of Treasury yields. On the other hand, we also had the Fed say higher for longer for the millionth time. And we got some, relatively firm jobs data this morning in the form of the JOLTS report, and the yields responded to that, too. So it's almost as if everything's pushing in the same direction.
Yeah, I think that's true. And look, if you allow me to just for a second put an optimistic spin on all this, the reality is we're kind of going back to normal. Before the great financial crisis, through the great virus crisis, which was the new abnormal, we had interest rates historically extremely low during that period. It wasn't that long ago when central banks were trying to get inflation up to 2%, but beware of what you wish for. Here it is well above 2%. But back before the great financial crisis, the bond yield was 4 to 5%, which is where we're back to right now. The risk, of course, is that some of the forecasts that it's going to go still higher, creating a debt crisis, is a realistic one, a serious one.
Yeah, I mean, and to your point, I mean, the bond yields at the 10-year maturity at 3 3/4 in July, you could sort of back out and say that's the wrong spot for bonds if we have a 5 to 6% nominal growth rate in the U.S.
Correct.
If inflation is still 3-ish at least percent right now. So maybe there's nothing strange about the levels we're at, but the velocity does unnerve the stock market, and it makes people question whether there's something else out here in terms of just the disorderly selling of bonds that's underway right now.
Well, Mike, I think there clearly is, and you mentioned it. The bond vigilantes aren't happy. The bond vigilantes have sort of been asleep for a long time because inflation's been so moderate. And as a result, the conclusion was, well, fiscal and monetary policies aren't all that excessive. But now with inflation kicking up here, during the pandemic environment that we saw basically an experiment in modern monetary theory, helicopter money just kind of raining down on people's deposits. And that was accommodated by easy monetary policy. Well, monetary policy was reverse course and has tightened. Meanwhile, fiscal policy has gone the other way and has been way too stimulative. And the bond vigilantes are being vigilant again about fiscal policy. They're basically saying, cut this deficit substantially, or we're going to raise rates to levels that are going to clobber the economy. And then what are you going to do?
Yeah, I made that point earlier. I guess the question then is, what are you going to do about it? Because it's going to be a pretty high bar in Congress to actually do anything about it. First of all, they can look at the move in rates and say the Fed's raising rates, and they're talking about keeping rates higher for longer. So it's not immediately clear that it's a protest of the deficit. And then if it does become clear, then what do you do? I mean, they can barely keep the government open and keep the U.S. paying its bills. Yeah. You think there's going to take an axe to discretionary spending?
Well, I think that's where the debt crisis scenario becomes a risk to the environment we've been enjoying, which is a relatively strong economy. The risk is that we get to bond yield levels that just really aren't affordable for the private sector. And in that scenario, it's conceivable that there would be a recession. And as you said, what do you do then? You can't increase outlays and cut taxes when that's exactly what got you into the predicament.
But it'll be on the Fed. Won't the Fed then just have to buy bonds again?
Well, I think one can see a scenario where the Fed is no longer doing quantitative tightening. I mean, Sarah, for all the talk about quantitative tightening, the Fed's portfolio actually shows an increase in their holdings of Treasury bonds of 10 years or longer. I think that indicates that even they're concerned about what's going on here in the bond market. They don't want to rile it up more than it's already been riled up. But the message to the fiscal authorities is you're out of control and you got to get back into control, or else the bond vigilantes are going to maintain some law and order.